Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we'll have a look at the latest high-frequency growth indicators across the globe. We'll look at a leading indicator for US inflation. We'll have a look at what's happening on the inflation and interest rate front in Europe. We'll also have a look at the reporting season in the US. And finally, we'll have a look at the mighty rand. We're going to start off with the latest high-frequency growth estimates. Every month, we refer to PMI data. Any number above 50 indicates an expansion in economic activity. Any number below 50 indicates a contraction. And the latest global number is well above 50 at 52.5. Now, the current consensus forecast is that GDP growth across the globe this year will be 3%. Last year it was 3%. The year before it was 3%. And this number at 52.5 doesn't give us any reason to doubt that we're going to get to around about 3%. So we'll monitor it closely throughout the rest of the year, but at this point, it does look like we are sitting in a pretty buoyant global economic environment. Now, beneath the surface, there were a couple of surprising data points with regards to the PMI data. As an example, if we look at US manufacturing, the PMI data suggests that there has recently been a surge. Manufacturing activity has been pretty weak to stagnant in the US over the past couple of years. It wasn't helped at all post-Liberation Day with the tariffs, where we saw a further weakening. This data point stands out, and it does suggest that we're seeing a turnaround in US manufacturing. Now, it is just 1 month, and we're going to have to wait a couple of months for this view to be cemented. But in the back of our minds, we need to consider the possibility that we are seeing a quite sizable uptick in US manufacturing activity. Now, the reason that's significant is that it comes at the same time that we've seen a surge in factory orders in Germany too. So it's not just the US, we might be seeing a surge in developed market manufacturing activity. And that, of course, would be very helpful for commodity prices. So it's an important couple of series to monitor. We will provide updates over the next couple of months. It does again suggest that there's going to be some form of a floor for commodity prices, giving increasing industrial demand in developed markets. Another interesting data point to come out of this was looking at the US services prices paid series. It ticked up again. This series has a pretty strong relationship with US inflation 4 months later. The latest increase suggests that inflation in the US is likely to remain sticky for some time, and it's going to be quite difficult for the Fed to counterbalance what appears to be a weak labor market. We'll get confirmation of that this week. And inflation, which is above target and likely to remain above target for the foreseeable future. And this, I think, is going to be a very interesting dynamic to monitor over the next couple of months. It's going to be obviously very important for markets. And we will have a new head of the chair at some point in the next few months when confirmed by the Senate. And that person will have to deal with this quite difficult dynamic. And I think it's likely to be a key theme for markets over the coming 12 months. And that gets us to another key theme for markets. Over the past decade, up until Liberation Day, when we saw large sell-offs in the S&P 500, a decline of more than 1% in a day, what typically happened is that US Treasury bond yields would go down too, and that would mean that treasuries, the value of treasuries, would go up. And you could invest in risky assets like the S&P 500 with some level of comfort, knowing that in the event that there was a large drawdown, treasuries would be an effective safe haven. On those days, the value of treasuries would go up. And that was the typical relationship, again, over the decade up until Liberation Day. Post that, the relationship has changed. And this is quite worrying for global multi-asset investors. Over the past year or so, when we've seen sizable declines in the S&P 500, those have also come with increases in treasury bond yields, meaning that the value of treasuries has gone down and the dollar has weakened at the same point. And this happened on a number of occasions post-Liberation Day. So in that event, you end up with a large drawdown in equities, but you don't have treasuries increasing in value in your portfolios. So inadvertently, global investors have been shifted up the risk curve because treasuries are not the effective safe haven that they were before. Now, they might go back to being the safe haven they were before, but they're not acting like that at the moment. And that has a couple of consequences. First of which is that investors globally are going to be hunting for other safe haven assets, even if they might not be an effective substitute for what treasuries once were. Maybe they're a little bit inferior, but hopefully they provide some form of defense. And that might explain in part the rally that we've seen in gold. It also is going to present opportunities for other countries if they can act as safe havens. Japan used to be a safe haven and hasn't acted like that recently. But should it be able to do so again, we would expect to see a material strengthening of the yen off very weak levels. And this too, we think, is going to be a pretty significant theme for markets over the coming year. The hunt for safe haven assets and the opportunity for countries to present themselves as safe havens and see sizable inflows. Just looking at the euro, there was some debate in the latest ECB meeting about the strength of the euro and what that might imply for inflation. As a starting point, the link between the euro and inflation is pretty inconsistent over time. And as a result, we can't say with certainty that a strengthening of the euro will categorically lead to a drop of inflation of size X. It's a pretty variable relationship over time. Now, where we stand at the moment is that the trade-weighted, inflation-adjusted euro is roughly in line with the long-term average. So we can't say the euro is cheap or expensive. It's sitting at about fair value in the way that we look at it. But even so, there has been a pretty sizable decline in inflation in Europe. The latest numbers coming out at 1.7%, so below the ECB's target of 2%. In addition to that, if you look at PPI inflation at the moment is pretty negative. And it's not an easy situation for the ECB, because if you look at inflation across European countries, inflation in France is close to 0%, and inflation in Germany is close to 2%, so in line with target. So does the ECB cut because inflation is below target and close to zero in France, in which case it might be an interest rate that's too low for Germany? Or does it keep interest rates where they are, which is broadly the market expectation, but then you'll end up with interest rates that might well be too high for France? So this is going to be a tricky problem for them to resolve. Ideally, they would like to see a convergence of inflation rates. The market is ambivalent around the chances of a cut. It's less than 50% chance of a cut in the near term. So let's see how that pans out. But this data is going to be absolutely critical for the interest rate trajectory in Europe. So while we're in a situation where the ECB might cut, the US is expected to cut once to twice over the coming year, Australia has just hiked rates, and the market is expecting another 1 to 2 hikes by year end. And the Bank of Japan is expected to hike too. So we're looking at an environment of quite sizable monetary policy divergence across developed markets, with the US and potentially Europe cutting, and Australia and Japan increasing rates. This too is likely to be a pretty meaningful theme running through markets over the coming year or so. And that gets us to the reporting season in the US. We're 2/3 of the way through. We've got about 80 companies due to report this week. So we've got a pretty good sample. We can have a look at some of the numbers that have come through. At this point, close to 80% of companies that have reported have surprised on the bottom line, and it looks like earnings growth is going to be about 13% year on year. Now, 13% earnings growth is pretty good, and close to 80% of companies surprising on the bottom line is pretty good too. It's a little worse than we've seen over the last couple of quarters, but it's not a bad number at all. And this sort of earnings growth, I think, goes some way in explaining why the US market is trading on a forward PE of close to 22 times, which is pretty expensive by historical standards for the US and very expensive relative to the rest of the world. Earnings growth at the moment is 13%, but more than that, the market expects that earnings growth next year will be about 13%, and the year after will be about 14% off a very elevated base. And we'll have to monitor these numbers very closely and we'll update. We think those forecasts are pretty optimistic. But if they do pan out, then the market should be on a forward PE of 22 times. Our base case is that growth will come in a bit lower than expected. We will see some margin deterioration, and that's one of the reasons why we underweight the US. But if you do believe earnings growth is going to be 13 to 14% per annum over the next couple of years, then the multiple in the US is pretty justified. And finally, on South Africa, the rand has strengthened quite materially of late, now sitting at about 16 or so. If you look at the inflation-adjusted, trade-weighted ZAR over the long run, so this is the rand versus the renminbi versus the euro versus the dollar, and then you strip out inflation because currencies should depreciate in line with inflation differences over time. If we look at the ZAR over the last 50 years, there have been 3 structural breaks. around the Rubicon speech, and post that, the rand, after adjusting for inflation, was weaker than it had been before. Then there was the emerging market crisis, and again, post that, the rand was weaker than it had been before. And then in 2012, we saw that there was a fiscal deterioration in South Africa, where load shedding issues, and post that, the rand, even after adjusting for inflation, was much weaker than it had been before. And those were the three key statistically significant structural breaks in the currency over the past 50 years. What we've seen now is a reversal of the last structural break. Post the recent rally, the rand, after adjusting for inflation, is trading roughly in line with where it was pre-2012. And I think what we can interpret from that is that the structural reform that we've seen in SA, as an example, electricity, where we now have consistent electricity supply, the improvements in the performance of the ports, the fact that debt to GDP is likely to peak this year, all of that has resulted in the rand now trading in line with pre-2012 levels after adjusting for inflation. So that the 2012 structural devaluation of the currency associated with the structural decline in the SA economy has now been reversed. It is as though the rand is being traded in line with the pre-load shedding, pre-fiscal deterioration level. And what's interesting about that is that the rand is reflecting a pre-2012 type environment. Our bond yields are reflecting a similar sort of story. If you look at the spread between the South African 10-year bond yield and the US 10-year bond yield, it's actually sitting just a bit below where it was in pre-2012 levels. So the bond market is reflecting the structural reform story. The currency is reflecting the structural reform story. The only exception is the equity market. Our equity market is still cheap relative to the rest of the globe, still cheap relative to history. And if you look at 2012 and prior to that, the South African stock market often traded at a premium to emerging markets. It no longer does, as an example. So the entire ecosystem within SA, the financial ecosystem, the rand, fixed income and equities, all of that, the rand and fixed income, is reflecting a more normal environment in SA and expecting growth to pick up. The equity market is a bit of a laggard, and it does suggest that there's still an opportunity in South African equities should the structural reform story in SA in fact prove to be permanent. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.